What's up everyone? Welcome to Ardenia Americana, and today we'll be discussing a few different topics. We will be discussing the Austrian School of Economics, we're going to be talking about some books I've been reading, we're going to talk about investing, and we're going to talk about gold. Thank you guys very much for watching the video and clicking on it. Let's roll the intro.
Mírame, me ves altiva y orgullosa, mírame, como si fuera indiferente, como si me olvidara de que perdí tu amor, de que estoy sola. Mírame, pero hacia adentro.
When I explain stuff to people, when I start talking about economics with people, their ear it turns off, right? Economics seems like it can be complicated and difficult and esoteric and, unapplicable to our daily lives. But I beg the differ. And I think this kind of disconnect has kind of happened because people don't understand that there's different schools of economics. The main ones are the Chicago, the Austrians, and the Keynesians. And if you want to say like communists and socialists and those guys, you can add them to the list too. For a long time I've been telling myself, oh, I'm a Chicago boy, whatever, right? I decided to look into it. I got a book called Austrian versus Chicago, and the Chicago school is a lot more mathematical, a lot more, I would say they're a bit more modern than the Austrian boys. And basically what that kind of led me to do is I kind of did some searching in my brain and doing some reasoning, and I'm an Austrian. I'm an Austrian economist at heart. I'm not saying that honestly the Chicago and the Austrian, the differences between the two are super duper minute. At the end of the day, they're all free market people and want the complete of the free market. On the Austrian side, you have some anarchists. I'm not one of those kind of people, but there's some very slight variations. But the biggest difference to me is the Austrians are a lot more, I would guess, their rep is better when it comes to predicting unpredictable events, right? The Austrians kind of have this sense for picking out things that the errors in the system and trying to find what goes wrong in this mega capitalistic financial structure we've kind of built. The Austrian school is not as, I really would say it's not as complicated as the other schools, especially not the Keynesian people. The Keynesians, they run their models and crazy statistics and stuff, but the Austrian school I think is a lot easier to understand. Basically, it kind of follows like this. If you start to tamper with stuff, if you start to mess with the free market, and you start to manipulate the free market, such as changing interest rates from where they should be, from the free market decides, or maybe even not allowing things to go bankrupt, not allowing the market to find what doesn't work as well with what actually works, not allowing recessions. What all of this is going to do is going to cause a misallocation of capital. It's going to cause basically inefficiencies in the market. And when you have a system like ours that's completely based on debt, where people have to service the debt and the liquidity needs to continue to flow, inflation needs to keep on growing, so that our debt-related monetary system can work, you're gonna have hiccups, and that's what the Austrian school is really good at finding out. Now, I wouldn't say I know everything about any of these schools, but I'm definitely leaning towards the Austrian guys because actually I've been reading this book. It's called Black Swan by Nassim Nicholas Taleb. It's actually a really popular book. My uncle got this for me for my birthday, and I've been reading it. I'm about halfway through with it, and in this book he describes funny because he brings up Hayek, and he actually likes Hayek, but basically talks about like the completely unpredictable. As Donald Rumsfeld calls them, the unknown unknowns. I got that from the Boondocks. If you know what that is, Rummy starts talking about unknown unknowns, and that's a harken back to Donald Rumsfeld. Anyways, I was like 3 years old when he was talking about that stuff. But this book right here is really, really interesting because it basically says that there are some things out there that are completely, completely unforeseeable. All of our predictions on the future, all of our models, they will all get destroyed whenever this thing comes up. And it can be in an economic, financial sense. It can be in a, and really in any sense. It can be in a personal sense. Funny, I was reading this book. My girlfriend comes at me and says, "You know what? I want to break." We ended up solving that. But for me, in my own personal life, that was a black swan event. It was an unknown unknown, and I laughed because I was like, "Oh, that's this book is pretty rad." One thing that I've been heavily considering is if basically the Federal Reserve has been putting up a lot of money, a lot of money. All the banks have been devaluing their currencies, but that hasn't really affected the real economy. When I get paid, I'm getting paid not too crazy different wages than it was last year, the year before that. However, what has been inflated is assets. Asset inflation has been huge. And whenever you create currency, I think Milton Friedman talked about it, is whenever you have currency, whenever you create currency, you're going to have inflation. But it's all sitting in the financial world. And those asset prices are being artificially driven up. You have a financial system that's built upon the real. You have the real economy that's built upon a financial system. It's really a house of cards. And that's why I've personally decided that the most important thing I can do in my investing currently is to protect my capital. I want to protect my capital. In this world of misallocation, stock buybacks, and really a conflating of what value is, I'm deciding to go sit on the sidelines. I'm purchasing gold. That is a fact. I'm sitting on the sidelines. I don't know these prices. I don't understand them. They seem out of whack for me. And gold prices have been rising. I started purchasing gold back in November. So I'm a really, really new gold guy. And I'm buying gold at a lot higher price than if I would have started buying when I was like 16 or 15 or, what can you do, right? Gold prices dropped to like $1,000. They were in that $1,300 range. Now they're at $1,600 for a real ounce of gold. If you want to go to the coin shop and buy one. Interestingly, I checked gold prices in other currencies. Gold in euros is at an all-time high. Gold in dollars is not. The dollar is a very strong currency, and if you're an American, you can buy gold at a discount. Now, I'm not saying that that's the best investment in the world, but all I'm saying to myself as for my own personal investing journey, that's an opportunity. If I can buy an asset discounted to what it is currently trading at, because my currency is artificially higher because we're the world reserve currency, I might want to take advantage of that. Gold is basically a protection asset. It's you know what? I don't really know what's going on here. I can't really wrap my head around it. Or I don't think these numbers don't make sense. I don't understand these valuations, or I think that gold is, or you think that gold is severely undervalued compared to what the other asset prices are, for any number of reasons. Now, people will like to talk about silver. I'm a bit of a snob. As you can see here, I'm wearing a nice gold wristwatch. This is a 1940s Hamilton Dodson. This was made from 1938 to 1948. So the chances are this was made during World War II. Beautiful, beautiful timepiece. Actually, I'll show you guys. Gold hasn't really been hit by this inflation bug yet, at least in the United States, because our prices are being lowered by this really strong dollar. So I'm viewing this as a great opportunity to load up on gold. It would have always been great if I would have been able to buy it sooner, but hey, what can you do? Another really beautiful thing about gold is it has no counterparty risk. So let's say I have, all right, let's take it like this. When I trade an option, okay, that option has tons of counterparty risk. The other person can exercise the option, time, my brokerage has to close it. It's a very finicky, fickle. Not sure exactly what the word is. Asset, if you can even call it one. Now let's move it down. Okay, we're talking. You want to talk bonds? Bonds require the holder, whoever the creditor is, or the debtor, to pay the creditor the bond. Now you want to go to stocks. Stocks, you're buying a company. The counterparty risk is the company could screw up. I mean, that's everyone always knows that stocks can always go to zero no matter what the company is. But even cash has a lot less. I'm going down the line here, but cash can be printed. Cash can be created, easy, boom, out of anywhere. You put money in your bank account. That requires the bank. When I hold physical gold, the gold sits there. It can be in the safe. It can be in a vault. It can be in another country. It sits there, and it's yours. There's no counterparty risk to gold. Now you can introduce some, but it's a lot lower than those other types of assets. Now you have other assets too, like real estate and other things. But I live in Seattle. I'm thinking about, you guys already know, I'm talking about real estate investing in other countries. Maybe going down to, I got family in Indiana, so maybe going down to Indiana, buying some real estate. Anyways, guys, this is kind of what I've been up to lately. I really appreciate you guys watching the video. I hope you guys enjoyed the intro. The woman in the intro is Claudia de Colombia. She's a beautiful Colombian singer. Amazing voice. Thank you guys very, very much for watching. This has been Ardenia Americana. And I'm out.